Ever wondered what's the difference between long-term and short-term investing? Today, we'll unravel that mystery. This topic is crucial for anyone looking to build wealth through the stock market. Both seasoned investors and beginners alike can benefit from understanding the unique advantages and challenges that each investment strategy presents. So, what exactly do we mean by long-term and short-term investing? Let's find out. Long-term investing typically involves holding on to investments for an extended period, often years or even decades. Picture it like planting a tree. You nurture it, give it time to grow, and eventually, you start enjoying the fruits it bears. It's a game of patience, a slow and steady approach aimed at maximizing growth over an extended period. This strategy is often associated with a buy and hold philosophy, where investors make strategic decisions based on fundamental analysis and long-term growth prospects. On the other hand, short-term investing, often dubbed as trading, is like a high-speed race. It involves buying and selling securities within a shorter time frame, sometimes within days, weeks, or just a few months. Short-term investors or traders focus on quick gains from market fluctuations, employing techniques like technical analysis and day trading. The goal here is to make frequent profitable trades, capitalizing on the volatility of the market. But it's not just about time frames. Each approach requires a different mindset, skill set, and risk tolerance. Long-term investing is generally considered more passive, relying on the overall upward trend of the market. Short-term investing, conversely, is more active and requires constant vigilance of market trends and news. These two investing strategies are not mutually exclusive. Some investors may choose a hybrid approach, combining elements of both. Now that we know what long-term and short-term investing mean, let's delve into their risks and rewards. Long-term investors generally aim to ride out market fluctuations, taking advantage of the overall upward trend of the market over time. This means they're less likely to panic when prices take a downturn, knowing that markets have historically rebounded and continue to climb. This approach, while less stressful, requires patience and a strong belief in the fundamentals of the companies they're invested in. Now, let's contrast this with short-term investing. Here, the game is all about volatility. Short-term investors or traders thrive on the rapid ups and downs of the market. They aim to buy low and sell high, often within a very short time frame. It's a high-stakes, high-reward strategy that can be thrilling, but also risky. Remember, the potential for significant gains comes with the possibility of substantial losses. And it's not just about potential losses. Short-term investing also means higher transaction costs. Every time a trade is made, there are fees involved. These can eat into profits quickly, especially if you're trading frequently. Another risk factor in short-term investing is the reliance on timing the market, which is notoriously difficult. Even the most experienced traders can't consistently predict market movements, and one wrong move could lead to a heavy loss. Risk and reward are important, but what about the time commitment? The next part of our discussion will delve into the time and emotional discipline required for both long-term and short-term investing strategies. So, stick around as we continue to unravel the intricacies of mastering the game of investing. The time commitment is a significant factor for any investor. When it comes to long-term investing, think of it like a slow-cooked meal. It requires patience and a more hands-off approach. You can afford to spend less time actively managing your portfolio, making it an excellent choice for those with a busy lifestyle, or simply those who prefer a more laid-back investment strategy. On the other hand, short-term investing is akin to a high-speed chase. It demands more time, more attention. It's all about staying updated on market news and making quick decisions. It's a more active trading approach that requires constant vigilance and a readiness to act at a moment's notice. So, are you a slow cooker or a speed racer? It's crucial to understand that the time you can or are willing to commit to your investments can significantly influence your choice between long-term and short-term strategies. Time is crucial, but so is emotional discipline. Let's talk about that next. Emotional discipline is crucial in both strategies. Investing, whether long-term or short-term, isn't just about the numbers. It's also about the psychological strength to stay the course during the inevitable market turbulence. For long-term investors, this means resisting the urge to sell when the market dips or even crashes. It's about understanding that these fluctuations are part and parcel of the investing journey, and not letting fear or greed dictate your decisions. Short-term investors, meanwhile, face a different set of emotional challenges. The fast-paced nature of trading can be thrilling, but it can also lead to rash decisions based on temporary market movements or gut reactions. It's essential for short-term investors to keep their emotions in check, make rational choices, and stick to their trading plan. In both cases, maintaining emotional discipline can mean the difference between success and failure in your investing journey. Emotions are important, but there's another factor we need to consider: taxes. The holding period of your investments can affect your tax liability. This is one of the areas where long-term and short-term investing diverge significantly. For instance, in the United States, investments held for less than a year are subject to short-term capital gains tax, which is typically higher. It's taxed at the same rate as your ordinary income, which can go as high as 37% depending on your income bracket. On the other hand, if you hold onto your investments for more than a year, you're looking at long-term capital gains tax. This is generally lower, with maximum rates usually not exceeding 20%, and in some cases, it could even be 0%. That's a significant difference and a potential advantage for those leaning towards a long-term investing approach. However, it's important to note that tax laws can vary greatly from country to country. It's crucial to understand your local tax laws and how they might affect your investment strategy. You might want to consider seeking advice from a tax professional to ensure you're making the most tax-efficient decisions. Remember, it's not just about the returns you make, but also about the returns you keep after taxes. The tax implications of your investment strategy can significantly impact your net returns and ultimately your wealth-building journey. Now that we've covered the basics, let's look at some real-life examples. To illustrate these concepts, let's look at a couple of examples and case studies. First, let's consider the story of Warren Buffett, a quintessential long-term investor. Buffett, the chairman and CEO of Berkshire Hathaway, is renowned for his buy and hold strategy. He invests in companies he believes in and holds on to those investments for many years. This approach has allowed him to amass substantial wealth over time, demonstrating the power of compound interest and the benefits of long-term investing. On the other end of the spectrum, we have day traders like Ross Cameron from Warrior Trading. Day trading is a form of short-term investing where positions are entered and exited within a single trading day. Cameron's strategy involves meticulously analyzing market patterns and making quick decisions to capitalize on small price movements. Despite the high risks and intense time commitment, successful day traders like Cameron can achieve considerable profits. Now, let's examine a case study from the dot-com bubble of the late 90s. Many short-term investors jumped on the bandwagon of surging tech stocks, hoping to make quick profits. However, when the bubble burst, these investors suffered significant losses. Long-term investors who held diversified portfolios were better cushioned against this market crash. Let's also consider the recent GameStop saga. This event was driven by short-term traders who coordinated through social media to drive up the stock's price. While some traders made substantial gains, those who joined late or held onto their shares for too long experienced considerable losses. These examples show us that both strategies have their merits. Long-term investing can yield significant returns over time, with less stress and lower transaction costs. Short-term investing can offer immediate profits, but it comes with higher risks and requires a substantial time commitment. The key is finding what aligns with your financial goals, risk tolerance, and time commitment. Whether you choose to be a patient investor like Buffett or a quick decision maker like Cameron, remember to stay informed and make calculated decisions. Your investing journey is a marathon, not a sprint. All right, folks, that wraps up our discussion on long-term versus short-term investing. We've delved into the intricacies of these two approaches, highlighting their unique advantages and challenges. From the steady endurance required in long-term investing to the quick decision-making and constant vigilance in short-term trading, each has its distinctive rhythm. We've underscored the role of risk and reward, time commitment, and emotional discipline in shaping your investment journey. We've also touched on the crucial aspect of tax implications, reminding you that the holding period of your investments can significantly impact your returns. Remember, The choice between long-term and short-term investing isn't a clear-cut decision. It's all about what aligns with your financial goals, risk tolerance, and lifestyle. There's no one-size-fits-all strategy. So keep exploring, stay informed, and tailor your investment approach to your unique circumstances. Thanks for tuning in, and I'll see you in the next one.